Thank you, Etna, for the introduction, and good morning, good afternoon, or in fact, indeed, good evening from wherever you're dialing into this event from. It is really a strange set of circumstances to be talking to you digitally rather than in person, but I hope that what I've got to say over the next 20 minutes will be interesting and perhaps set the scene for much of the other discussion that will be taking place. My focus is going to be very much around the outlook for the global economy, and then specifically what that's likely to mean for the construction sector. And against the background of the uncertainty fueled by the pandemic, the challenges around interpreting some of the economic data are certainly quite taxing at the present time, and probably more so than at any point, certainly since the onset of the financial crisis in the latter part of the previous decade. So let me start talking a little bit about the economic outlook and what are people saying? What are the big forecasters talking about? What sort of numbers are they coming up with? Well, it so happens that fairly recently, the IMF just upgraded its analysis. It does it sometimes twice a year. At the moment, it's sort of updating it a little bit more frequently to try and capture what it believes is going on in the underlying economy and how this is manifesting itself more widely, and also indeed what the prospects are, not just for next year, but beyond. So the slide that you've got on your screen at the moment shows the forecast that they've just announced for 2020 this year, and then the forecast for 2021. And the purple blocks are for this year, the turquoise for next year. What you can see here in most cases is that there's not surprisingly, a negative for this year. You wouldn't expect anything other than that. And I haven't obviously gone across the globe. I've tried to identify a number of the key areas or key economies. You can also see, if you look at the turquoise blocks, that with one notable exception, the numbers for next year are not as strong, the positive numbers for next year, I should say, are not as strong as the negative numbers for this year, which means that the IMF, in most cases, doesn't believe that at the end of next year, an individual economy that's been referenced here will be back to where it was at the beginning of this year. So it's showing just how painful the impact of this COVID-induced downturn is likely to prove to be over a period of time. It's not just the short, sharp shock that we've all seen, but something that will be a little bit more protracted. Now, there is a notable exception there, and you've probably spotted it, towards the centre, China. China has had sort of rather more success in dealing with this particular virus. And as you can see, at the moment, the IMF believes that there will actually be positive growth this year. And next year, growth will be approaching the 8% mark. So certainly a very different picture in China from many other parts of the world. In general, the expectation, as you can see from this, however, is still for some sort of recovery through the course of next year. People are characterizing it as that Nike swoosh. I just don't believe it's going to be as smooth. And as we see in the Northern Hemisphere, the re-emergence of COVID cases and what that is meaning for economies and government interventions, I'm far from convinced that this is going to be a very smooth recovery through next year. Some more risks, unfortunately, still to be faced. Now, what is absolutely critical is that governments and policymakers more generally intervene in a fairly dramatic way when there is a crisis like this. Failure to do so ultimately leads to even more pain. And there's some work actually that I've just shown you the essence of that work on the screen that's been done recently by 3 economists. And they've tried to identify what happens over the medium term with a strong government response to an epidemic or a pandemic, and then perhaps a weak government response. The strong response is on your left, the weak on your right. And as you can see, we look at the year of outbreak, and then what's going to happen over the next 5 years. Now, the really interesting thing about a strong spending response and that activist government is that in the first year, the typical loss in the pandemics and the epidemics that they observed, the typical loss in output was around 2.5%. Within 5 years, or by 5 years on, they had narrowed the loss in output compared with where the economy would have otherwise been. So back on that growth trajectory is, a mere 0.5%. Now, if you look at the example on your right, where the government is not anywhere near as active, you can see that 2.5% after year one obviously is the same, but that actually, if we look 5 years forward, the loss of output compared with where the economy would otherwise have been if it hadn't been an epidemic or pandemic is 3.5%. So the picture actually worsens. So strong and bold initiatives from the government are absolutely critical to minimizing the medium-term fallout from these sorts of episodes. So what has happened this time? Is the government doing enough? Is it on that left-hand side or the right-hand side? Well, I'm pleased to say that it's certainly very much at the moment on the left-hand side. I mean, I could characterize it as big government is back. That's quite a strong statement, but there's no doubt that the activities it's sanctioned around revenue reductions, spending increases, have been quite substantial, approaching 10% of GDP globally. And there's been a range of other supports, equity injections, asset purchases, credit guarantees, all very helpful. Alongside that, the US Federal Reserve has really taken a bold step. Now, the US Federal Reserve has done this on its own. Other central banks are a little bit slow to follow, but let's remember, the US Federal Reserve is really important in setting the agenda in terms of interest rates globally and the approach to monetary policy. What have they done? Well, they've basically said, in the past, 2% inflation is a problem, we're going to raise rates. What they're now saying is, we've had a long period where inflation's below 2%. We can afford a long period where inflation's above 2% before we do anything. That's a real change of focus. It means that they're actually trying to generate inflation. Not many central banks in recent years have said that. And that really is a bit of a game changer because it really means that interest rates will stay lower for even longer. And then finally, I want to pick out one more example, and I'm sure you've got other examples of bold and imaginative moves from wherever you are in the world. But let me pick this one out from the EU, and it's a really significant shift. The whole idea of debt mutualization, the EU actually issuing bonds in its name and then distributing those proceeds as a mix of loans and grants to the most needy countries in Europe. This has never been done before. So a real change of focus there in a number of different areas and really reflecting just how important the governments recognise intervention is and significant intervention at this point. Now, public investment, and I think this perhaps particular relevance for this event, public investment infrastructure construction is being seen as being an important part in the delivery of the recovery over the next year and beyond. But by no means have all spending measures been linked to this. Obviously, there's a lot of short-term current spending that is being sanctioned at the present time and much needed short-term current spending. But ultimately, driving that medium-term recovery, public investment is seen as having an absolutely pivotal role. And that's because the fiscal multipliers, that is the knock-on effects of that investment, are so strong and so much stronger than other forms of government intervention. So a tax cut, for example, just doesn't deliver the same bang for a buck. And again, the IMF's done some work here, which was trying to identify the impact of a 1% increase in public investment, that's as a share of GDP, in a number of different circumstances, and also for all of the global economy and also for advanced economies. The area I want to point to is that red block. In each of those, the red block is periods of high uncertainty, and it shows that a 1% increase in public investment as a share of GDP delivers outsized returns during periods of high uncertainty. In that left-hand side, you can see it leads to a 2% increase in output over a 2-year period. In the middle block, you can see it really does encourage the private sector to respond. Private sector investment up 10% on this analysis over a 2-year period. So it builds confidence in the recovery. And on that right-hand side, it also delivers a rise in employment. And the IMF estimates, and I put that there just because I think it's worth highlighting, the 1% increase in public investment as a share of GDP will create somewhere between 20 and 33 million jobs worldwide. And obviously, the more you see in terms of public investment, the bigger the kicker in terms of the confidence it delivers for the private sector and employment. So this is part of the recovery strategy, and it does deliver good results. That's the evidence from the past. Obviously, there aren't any guarantees about how things will shape out over the next 1, 2, 3, 4 years, partly because we don't know how the pandemic will develop and whether it is something that will prove more pervasive than at this point we hope. What does this mean in terms of the construction outlook? At this point, I'm going to turn to in fact, my own survey, the RICS's survey. We do a survey every quarter of our members around the globe, ask them about what's going on in the construction sector. It is a sentiment survey, no more than that, but it gives us a good steer about what's happening. And you can see from this chart, I've broken it down by broad regions, that take the bars on the left, the Americas. The expectation for the next 12 months is that private residential and non-residential will both be still fairly subdued and slightly negative, but the expectation is infrastructure will be positive. In APAC, again, that red block showing infrastructure leading the way. Europe's a bit of an oddity there. It doesn't seem to be the case, and I'm not sure I fully understand that. My suspicion is a timing issue, because there's been a lot of announcements around infrastructure, and I would expect to see, as we move into the next quarter, that red bar push up. And then in Middle East and Africa, the red bar, again, very strong. So the expectation is that construction overall may still be fairly flat over the next year, actually, but the infrastructure component is generally going to be the sector that delivers. And then I suppose private housing, private residential alongside that. It's the commercial side, office, retail, for perhaps obvious reasons, that are going to be lagging behind over the next couple of years in terms of development. How green are the plans of government? There's been a lot of talk about infrastructure, a lot of talk about green recovery, a lot of talk about building back better. Well, I think that the idea of the infrastructure recovery is something that I think that there's a lot of evidence to support. But most of the analysis says at this point that for all the talk about a green recovery, the evidence just does not bear that out. And this is some work by a consultancy called Vivid Economics. I'm not going to dwell on it, but you can see in most cases, most countries, the perception from their analysis is that the stimulus measures have actually been negative rather than positive in terms of the green agenda. So really quite a salutary sort of chart, I think. European Commission coming out top of the tree there, but it does highlight some of the big challenges, particularly if we're talking about something that's sustainable over the medium term. Now, given what I've been saying, what are the impediments for development over the next couple of years? What are the main ones? And again, I go back to the RICS survey for this, because we ask this question every quarter, and we pick up different themes from different parts of the world. But what's really interesting is the consistency of one of those themes, financial constraints. Now, if you're talking about infrastructure, that may be in part about government commitments. It may be about trying to encourage private investment into the sector, which has proved challenging, despite, again, a lot of talk about the subject. If you're talking about, let's say, residential and perhaps the SME sector, it might relate to bank loans and availability of credit for developers. But it's quite clear that financial constraints are, in each of these markets that I've highlighted here, a big challenge. Insufficient demand has shot up. It wasn't like this 3 quarters ago. It's just simply a reflection of the cycle and where we are. What's interesting on that red block there are the skill shortages. That's really gone down, and that's a reflection, I think, of the fact that demand's eased off. I think that in many parts of the world, there is still a skill shortage when it comes to development, and I think we will see that re-emerge. But for the time being, and indeed it's been an ongoing theme for the last couple of years, finance is really a big issue, and that's one that I think that governments have got to, and policymakers have got to think about in terms of trying to, very really keen on the construction sector and infrastructure to really help stimulate a stronger economy, hopefully as we move through the course of next year and COVID begins to diminish as a drag on activity. Now, I want to sort of really bring this to a close by returning to the medium-term outlook for the global economy. And the first of these last two slides, I'm going to look at some work again done by the IMF, and this is again looking at their medium-term forecasts. I've broken it down into three categories: advanced economies, the emerging and developing, and then the lower income economies. And you can see, if you look at the difference between the purple blocks and the turquoise blocks, purple was the January forecast, October forecast, and turquoise, just how the forecasts have gone down. Now, remember, I showed you earlier the 20 and 21 forecast. This is a 5-year per capita cumulative forecast. So it's different, partly because it's doing it per head, but also because it's rolling out over the period up to 2025. But you can see in the space of 9 months, we are talking about significant loss of output over the medium term, not 1 or 2 years. So what does that tell me? Well, it sort of implies that despite the very strong response from governments, because we talked about that earlier, they've been really bold, really imaginative. There is still some scarring on the global economy wherever you are. In all 3 blocks, the numbers now expected for the next 5 years are lower than the numbers that were previously expected. And 2 of those cases, you can see the numbers are lower than what was actually achieved between 2013 and 2018. And that was a period which we're still coming out of, in some respects, the legacy of the global financial crisis. So it wasn't stunning growth, but nevertheless, you can see that there is, particularly in the advanced economies, a significant loss compared with that period. So, finishing off then, there are some significant challenges for policymakers to address. There's no getting away from that. First of all, they're going to at some point have to resolve the debt overhang. However you look at it, public sector debt is now at pretty high levels. As a share of GDP in many countries, it's back at the levels last seen in the 1950s. The big difference is that inflation is subdued at the moment, and that means interest rates are low and that debt servicing costs are also low. But it's hard not to believe that there aren't going to be some medium-term consequences, which probably explains why growth forecasts looking out over the next 5 years are relatively subdued, because we at some point are going to have to pay back some of this borrowing. Secondly, the whole issue around the framework for managing monetary policy, and I referred earlier to the US Fed branching out on its own, really making a big change in the way it's looking at how it manages policy going forward. I think this is something that's going to have to take hold more generally, particularly if inflation doesn't revive, because one of the things about low interest rates is it fuels asset price inflation, and that in itself creates its own problems. So that's something that's we're going to have to think about. Ensuring growth is environmentally sustainable over the longer term. Well, we've all heard about stranded assets, and they exist in lots of sectors, including the construction and development sector or the built environment, and that's something that as we look towards the medium term, I think it's a really imperative that that the new developments, the construction, the infrastructure is really built to a different standard and really does meet those high sustainability criteria. Because if we don't, I think that we are potentially building up another problem. It may not be one that immediately emerges, but I think it's one that will emerge. I think we also need to really focus on building skills to manage the economic transition. And again, that really does feed into this area of construction and development. I mean, it's not the only sector that is in need of perhaps, and obviously I'm talking in general terms here, specific countries may not have that problem, but it's not the only sector that is in need of skills, that finds itself with a workforce that is perhaps diminishing in size and perhaps not skilled up enough to manage some of the transitions that are required. So a lot of work going there. And also, I think, one of the legacies of the global financial crisis, very visible, has been the rise in inequality both within countries and across the globe. And I think there's no doubt that that's contributed to perhaps some of the political dislocations that we've seen around the world in recent years. So creating a more inclusive approach to macro policy going forward, I think, is absolutely critical. Now, I've rushed through a lot of different themes there, but I hope it's been interesting. I really want to thank you for your attention, and I hope on another occasion we perhaps can have this presentation face to face. Thank you very much for that.
And Simon, thank you so much for that, really interesting, very, very engaging too, I have to add. And I just love your approach in terms of how you explain what's going on there, looking at the global outlook in terms for construction. And of course, this is very much a global show. We have people from around the world joining us. So I'm delighted you've taken the time here to join me in person. Great to see you. Thanks for being here.
It's a pleasure, Edna.
Now, talk to me a little bit. Despite the doom and gloom that's there, you're actually quite encouraged, but obviously in the post-COVID recovery, there's still a lot of work to be done. And I was just watching very, very carefully. I'm going to come back. And this is the lovely thing about the fact we can replay these, really look at that in detail. As you said, when we look at that 5-year term, quite a lot of damage, I suppose, has been done in the last year when we were trying to catch up from the previous recession as well.
Yeah, look, I think that there's sort of obviously a lot of uncertainty at the present time. There's some good news, and I think we should be positive. We should really take heart from the good news around the vaccines or potential vaccine and rollout. That if it lives up to some of the hype that we're hearing about, will create a nice firm base as we move forward through 2021. And I think that one can't also minimize, and without getting into the politics of all of this, I think that one can't minimize the importance of potentially having a more, I suppose, firm and consistent approach coming out of the US, and that might be associated with a Biden administration from 2021 onwards. I think the potential over the sort of the medium term is that more consistent approach will provide a lift to sentiment. And, in terms of investment flows globally and investment flows into the Middle East, that ultimately could be quite a positive development. These things don't turn around overnight. But I think as we look through over to the middle of this decade, we could be looking at a more positive environment.
Well, I think we certainly need to be looking at, and that's what everybody is hoping for, that uncertainty. I think the volatility in the market. And of course, I think just the complete disruption with the US election for a few weeks. But the fact, as you say, some sense of stability is there, particularly for the US. And indeed, I think for global outlook, people are very happy that now we've got a decision and life will move forward. But also when we look at, as you said, the governments have been incredibly proactive. They're not they're not waving the austerity flags here. There are some big infrastructure projects in place. But is this enough to actually boost the economy? Because we're still not out of this. And I think, we had one question in here actually saying, is there a danger that 2021 will actually be a year of recession, maybe the worst ever, going back to the 1920s?
I hate to sort of, I don't want to sort of feel overly confident about 2021, but I actually feel there's enough there to actually be talking about a slightly better story compared with 2020. I think the fact that the vaccine rollout is potentially going to take place during the early part of the year. I mean, obviously it's going to be unevenly distributed, and that is a factor for some states. But overall, that direction of travel has to be seen as positive for sentiment. So I'm not sort of expecting 2021 to be worse than 2020, but I think you're absolutely right that, policy levers need to be pulled. There's been a lot of rhetoric expressed about, what should be done. There has to be follow through. I think actually there was another note from the IMF, and sorry to draw so much on the IMF in this conversation, but they put out a note at the end of last week, tied in with the G20 meeting as well. So, it's very pertinent. And I think one of the key points they made was that policy support mustn't be withdrawn too soon this time round. It's absolutely critical that the levers are pressed hard and they remain in place through this next short while so that we can get some visibility of the recovery and that sentiment does improve. Those, I mean, it probably is a bit crude to talk about animal spirits, but we get business operating with confidence again, and embed this recovery process.
And absolutely, and I think that was the message even this weekend's G20. I think that absolute commitment that is there, and I think the sense of urgency that everybody understands, that everybody is talking about it, but also I think too, and you had talked about in Europe, you know, the EU bonds there for the debt neutralization for the poor countries, but also that divide, the gap and the divide between, you know, the poor and even the poorer. I mean, I think this is, you know, the IMF said that very, very early on, the danger is, you know, that the poor in a situation like this will get poorer. So the development that has to be done, I think, in continents like Africa and Asia and all of that, and that's infrastructure development that's long overdue. It needs to happen. But this is something I think that we're seeing a commitment, a global commitment for.
No, you're absolutely right. And I think, you know, look, we often hear about infrastructure and construction as being in the front line. I think that never more so, though, and it, you know, really apposite for this festival, that, you know, construction stroke infrastructure has an absolutely critical role. I think that, you know, in many parts of the world, the spending in this area is long overdue on some big projects. We know that, you know, there's an awful lot of work to be done. But it's combined with this whole focus on recovery and also the green angle on the recovery. And I think infrastructure construction is uniquely placed to deliver across all those goals. So really, you know, absolutely critical, but it also carries a lot of responsibility with it because, you know, sometimes in many parts of the world, I mean, my own country, the UK, you know, is certainly no exception to this, that these big infrastructure projects haven't really delivered to the time, to the costs, in the way that was expected. And I think the industry really has to step up to the plate and show that it can, you know, meet these goals and do it in a cost-effective way and to the timelines that are set out.
Yes, of course. I mean, it needs the public and the private support too, but it also needs financing as well. Yes, from the government, but also, you know, when you look at the financial risk of COVID, you know, are they reducing our investors out there? Are they looking for good projects? Are they actually ready to commit? Or do you think we're a few months away from that yet?
Well, I think the finance issue is an absolutely huge one. And, you know, yes, governments have got to play a role, but so has the private sector. And I was on a call with the Global Infrastructure Hub a few weeks ago when we were just talking about this issue of how you lever in private funding to support these big projects. Actually, if you look over the long term, the returns to infrastructure are pretty good. But despite that, there still seems to be a reluctance of the private sector to commit on the scale that's required. And I think part of it is because of the duration, the length of time some of these commitments are required for. And perhaps that doesn't always foot in with traditional investment time horizons. But I think you're absolutely right, but this is a mix. It's a public-private combination to deliver these goals, and without that funding and without the private sector involvement, it isn't going to work on the scale required.
Just before I let you go, can we have a bit of a wider view on the real estate market when we're looking at it at the moment? We see here in the Middle East, here in the UAE, prices are depressed at the moment. That will change. It's a cyclical business. We know that from around the world. But what's your view on the real estate market for, I suppose, the near term?
I think that there's some big structural challenges for the real estate market. Certainly, if one's looking at the commercial market, we're all aware, and this is obviously depends. You know, the speed of this structural change depends on where you are. But there are issues about retail. We were aware of this prior to the pandemic. There are interesting discussions about offices in many parts of the world. one of the securer areas of the real estate market, despite it being depressed in parts of the Middle East and other parts of the world, in some areas, is residential. Ultimately, that is still going to be a strong story over the medium term.
And indeed, we'll be talking a lot about it, I think, in the days to come in all countries around the world. Simon Rubinsohn from RICS. Thank you so much, Simon. That was really engaging and interesting, and I'm sure people found it very informative. So I'm very, very delighted that you've been with us and our opening keynote. Thank you so much.
Thank you, Etna.